So now we're going to move on to what's in the black box of being an angel investor. Valuation and risk. And valuation is both an art and a science. And in this stage, I think it's more of an art, right? So let's welcome to the stage our panel for valuation and risk, Miss Cara Glasheen. I'm sorry, I watched too much TV. Cara Gee's on The Expanse, I think. Miss Cara Glasheen at Sandbox and Women in Venture will moderate, along with Miss Erika Bahr, CEO and founder of Invest Capital AI, which is an extremely interesting company. And of course, my friend Paul Nolde, welcoming him back to the stage, Managing Director of 757 Collab, 757 Accelerate, and President of CAV Angels. Let's give him a round here. Welcome him for Valuation and Risk.
All right. Sounds like it's on. Very good. Okay, so thank you all for being here today. As stated, I'm Cara Glasheen. I'm representing Sandbox, and I'm about to introduce you, if I can get this working. Maybe I have to be over here. Sorry. Technical difficulties. I have some slides because with this topic, we've got a bit more content. So I might have to be over here. Sure. Thank you. All right. Now I've got an assistant. So I'll be right here and I'll give you a little cue as we move forward. So the next slide, I have introductions, more thorough introductions to our two panelists here today. First, I'd like to introduce Paul Nolde. He is, you've heard from him a few times already, but really highlighting his experience in this venture area, both in family offices and funds, and now, of course, the 757. And also we have Erika, who is here representing her company, Invest Capital AI. And so she's a great person to think about the risk involved in making investments. And to get started, I'd actually just like you both to answer a quick question of, what specifically from your background would you like to share with the angel community? Top notes about valuation and risk.
Erika, you want to go first?
Sure, I can go first. So we focus a lot on de-risking startups and helping them to be more competitive when they go out for VC funding. We also help angel investors and VC firms to do AI due diligence to help them better assess their investments that they're making. This is your money. This is a lot of things that you want to be very careful with how you allocate your money, where it goes, what you're putting it into, and being able to know these startups inside and out through leveraging tools and the expertise that currently exists in the market to know whether it's a good investment or not. So I would say the number one thing is just understand that angel investment is a huge risk, but it's a risk that you're willing to take. And if you use the appropriate tools and methodologies, you can not mitigate the risk, but you can reduce it and control it a little bit better. So,
yeah, it's well said. I think, and then I'll maybe provide a counterbalance to that and say I've also appreciated the fact that it's very much a balance between art and science, and especially around valuation. There's so much about valuation that, and you'll see later on, you can calculate a valuation many ways, but at the end of the day, you're still having to ultimately negotiate that valuation, and that's where the art comes into play. And so I think there is being a savvy investor, whether at the angel stage or at a fund level, is just appreciating when to flex the art side and when to rely on the science side, because you definitely have both of those that come into play.
All right, and so for this session, I do have some more slides. It's a little bit more lecture-oriented, so apologies, but I hope Tracy can make some of these available afterwards as well. So with valuations in general, first I wanted to speak on just why these matter, what it means when a valuation might be too low or too high. And usually I'm speaking to founders. So this is sort of the opposite situation where for a founder, we're trying to help bolster them, help get a higher valuation for you guys. And in a few slides, I'll show why it can be beneficial to you to get that lower valuation. And that's really one of the benefits about investing as an angel versus someone in a later stage. But still, there's a risk of investing in a company when the valuation is too low. And I think this has been mentioned a few times today. It's around this misalignment of the incentives between the team that you're really trying to support and, of course, your potential return. And also, if in an early round, we know a lot of these startups, they're going to have to take additional rounds of funding in the future. And if we have a really low valuation to raise a lot of money, that's going to dilute the founder and could potentially limit their ability to raise in the future. So as you're making that investment, it can be really useful not just to think about how do you maximize your own return, but also how do you help guarantee the success in the long term for the founder. On the flip side, if the valuation is too high, this could actually make it harder for this venture to raise in future rounds because they're going to have to go out and they're going to try every time they raise to increase that valuation and increase that valuation again. And if they start really high, there might not be anywhere to go if they don't make traction as quickly as expected. So again, there's some danger there. Of course, we hear about down rounds. These aren't necessarily the end. Valuations are subject to market conditions, and it happens, and startups can overcome it, but we like to avoid it. And of course, for you all as investors, when you're investing in a higher valuation, that actually means you get a smaller percent of the company for the same amount of money. So again, different sides to balance. We really want to try to find valuation that works both for you and the startup you're investing in. But of course, for a shareholder consideration, you should be thinking about how you're going to get your money back. It's going to take a long time, potentially, before this leads to a return, making sure that's well understood. And also, just in general, how will your investors be compensated for this very risky area of investing? So now I'd like to hear from the panelists. Specifically, maybe Paul, you can start sharing an example from your experience where the valuation of the startup was a critical factor in making an investment and how you approached coming to an agreement.
Yes. So one of the first investments I did when I was running a small seed fund was with a company that I think they initially were asking like $9 million pre-money valuation. You know, their valuation before they did this round that I ended up leading. And I had a number that was based on my diligence, and in this case, it was a little bit more, it was more qualitative than quantitative, just because the company was early. We didn't have a whole lot to go on the numbers. So I had a $6 million valuation in mind. So that's a healthy gap, $3 million, but it's not. It was certainly, it gave us enough. It was close enough where there was an alignment between the founder and myself, or the founding team and myself, where we both recognize the value in having each other at the same table. And so we went through a couple of back and forths, which is going to happen, right? Investors are going to come in low, founders are going to start high, and you start to whittle your way down. Well, it got to a point where we were like, I went up to, I think, I was like, look, I've got, for this fund, I've got to be at a $6.5 million pre-money valuation to make the numbers work and to justify me making an investment. And the founding team was like, well, we really need $7 million. That's as low as we're going to go. So that's a $500,000 that could have prevented a great deal to happen. So I went to people much smarter than me on the math side and said, okay, how do we make this work? And this was something where we ended up working out. So they got the valuation of $7 million. Even though I needed a 6.5, we worked it out through the option pool. So I think Kyle had mentioned earlier about the waterfall. And so we waterfalled kind of how an investment would play out if we did a $7 million pre-money valuation, but then we included, in this case, it was like a 12%, which I thought was too low, but still 12% option pool. And the way that the math fleshed out, it actually gave me the $6.5 million after the numbers fleshed out that I needed. And again, I will be the first one to admit I am not a math person, so you wonder why I'm in this business. But it's really, I rely on others for that. But but it worked out. And so, in that case, it was, that was a good outcome with a higher valuation than I wanted, because it actually benefited the company. Because before that, they only had they had like a 7% option pool, and they weren't willing to negotiate on going up. So it was a good way to kind of use that as a tool. And again, a bigger option pool, better for the employees, better for the founders, because that's how you end up in later rounds incenting them. So that was something that was unique. And I don't know if I've done a deal like that since, where I leveraged the option pool to make the numbers work. But it just goes to show that's where the science comes in, right? Because you're dealing with hard numbers there. So I think that's a piece where the science came into play, but the negotiation piece was critical. So,
and Erika, I'd love to hear your thoughts in general about some of the other trade-offs around these negotiations.
Yeah, so I'm a little bit different because I see valuations in aggregate, right? I'm working in the data, so I see how valuations change over time. And I think that's really important for you to understand as well, that valuations do change over time. They change geographically, depending on where you are. The valuation of the startup could be different. And so doing your research on the startup that you're going to be investing in, making sure that you understand the valuations for their current status or their current industry and your current area, what people are paying for companies. And then also our machine learning models change over time, because they have to be able to adapt and learn from the current valuation so they can change for the future valuations. And so I just wanted to highlight that part of it. That's also really important to understand the aggregate aspect of valuations.
And so this next slide is, I think, maybe a little bit out of the bounds of this talk, but I thought it's useful still to bring up when we're talking about these valuation and the risk involved in startup investing, particularly for angel investors. So the numbers you see on the screen, this is a typical VC logic around their investments. They expect that about a third are going to be write-offs, about a third are going to be partial returns, and about a third are going to yield results. And so this is why we often hear of this idea that startups should be able to promise this 10x investment, because to get that return, they know they're going to lose some. And if they're going to end up with a performance of 3x or so on the average, they need to really make sure they're investing in these high potential growth businesses. So there's some examples there, but really I'd like to hear from our panelists, and what's the difference between this VC mentality versus the angel space, and how can potential angel investors in the room use this sort of framework to think about making their own investment?
You want to take this?
Sure. Yeah, so it's going to be different. Obviously, there's going to be VC valuations are going to be different than angel stage valuations. The real challenge with angel stage valuations is, and you can correct me if I'm wrong, I'll let him correct, there's some like guesswork in it, right? There's a lot of guesswork. Yeah. And for me, being in the data field, that's shocking to me, of course, right? Like, okay, there's a lot of guesswork, but that's important to know. That's important to know, like, what are solid things that you can value? What are other IP properties worth? What are patents worth? What's, like, for example, what is a biotech patent worth these days, especially in that kind of space? You can use tools to help you with this. This isn't just something you have to figure out on your own by just talking to people. You can go on to Google Patents. You can search patents. You can see what they're priced at. Like, you can actually do this. And so that's where I always say, like, use the modern tools that we have to do your investments. They're just going to help you be that much more accurate in valuations. And it's not so much like I think it's this. Someone I know did this, so that's what it's like. You can actually do a little bit more research than you think, but there is still that element.
I agree 100%. I mean, I think there is a lot of guesswork, but I try to, when I talk to founders and we get to the point where we talk about valuation, I always want to appreciate their rationale. So what is their valuation? What are you basing your valuation off of? I want to hear, is it rooted in some type of math? Is it rooted in just a market assumption? And then from there, it helps me understand, okay, let's inject either some reality into it, or, is this, or do we have to go a different route? So I think there is at this early stage, there definitely is, I think, more guesswork than you would think. It's kind of, to me, it's a lot like when you do this enough times and you interact with a founder, there's a gut feeling that you have. And usually you pay attention to your gut as to, is this the type of founder that I want to work with? And but it takes time to do that. And so before you get to that point where you can start to size up a valuation or a company or a founder, pretty quickly, I think relying on these tools is absolutely critical. So, and as far as that rule, the rule of thirds, I still think that applies to angel investing too. I mean, that's kind of what I've seen. I think it's been a tried and true, ratio through much of the venture capital and angel landscapes. I mean, I'm sure there's some movement there, but I think if you go in with that mindset, when you look at your pool of capital, risk capital that you want to deploy, I would go in with that mentality so that when it happens, you're either not surprised or it doesn't spook you the first time that one of your companies just goes bust, because you're banking on the fact that one or two in your portfolio of, 10 to 12, maybe more companies is going to make up, obviously, what you've lost. So, which is a whole nother conversation. But I think, it's that's why this is such a risky asset class, but it's also fun. It's like legalized gambling. So it's great. I mean that in a good way, by the way. So,
and I think that's interesting to hear, this idea. VCs go through some intensive due diligence.
Yeah.
And if you're saying that angels can get approximately similar success rates, I don't know what that says about VC.
Yeah, I think in the early stages it might be true. I don't I worked at a Series A fund and then seed fund, and now I'm running an angel network, and I would say that with each kind of tranche of capital, you have more operating history and more financial history to go off of, which means you have a better idea of where the company might be headed. So I think that, it definitely, as you get higher up, it's a little bit, I'm not gonna say it's easier, but it definitely, you can diligence it more finely. So.
The next. So now this is going to get a little lecture-y again. I wanted to bring up a specific example because when we're talking about these high valuations versus low valuations, what you see, this is a very simplified version of some cap table math. So on the top line, when we talk about these like pre-money values, pre-money valuation, we're assuming here a company with 10 million pre-money shares outstanding. So that means before investment. And then we're assuming a pre-money valuation in this example of 8 million. Then there's this seed investment that comes in. It's a pretty large seed round, but it makes for nice math, 2 million. And then what we're trying to figure out is what's the price per share. So at that point, at this valuation level of $8 million pre-money, the 2 million is put in, the share price is 80 cents per share. And then that leads to, this is a sort of mini waterfall situation. You've probably heard the waterfall come up a lot. And so you can see the resulting ownership from this seed round because of this $8 million valuation. Now, if you could progress. Now I'm showing the numbers as if we were doing the same exact deal, all other things equal under a $4 million valuation. The biggest thing to point out is that now our share price has been cut in half. You're getting a much better deal, essentially. But this also results in the long run into something interesting of this higher percentage of ownership by this seed round. So in the exact same conditions, all we did was cut the valuation in half. It might seem negligible, but in the first example, the founder's getting diluted by 20%. Second example, diluted by that 33% of investment. So I think this is really one of the key points I wanted to make sure is understood of why it matters to think about valuation when you're making these early stage investments. But beyond this, I would love to hear more. I know Paul mentioned this a little bit, but if you're feeling stuck, what are some other things that as an angel investor you might negotiate on besides valuation that can help even things out?
Well, I mean, there's several things you can negotiate on the board and how the board looks and the governance side. So, is it 3 board members at this stage or 5 board members? I wouldn't go over 5 at this stage, but and then where is your place on that board, right? Because there is also, there's the operations side and the math side, but then there's the governance side, and you can have, you want to work alongside and with the founders, but there are also times when you as the board have to make decisions that affect the health of the company apart from the management, and I think, and hopefully in alignment with the management, but sometimes not. So I think your ability to ensure that you have a voice on that board in some way, shape, or form, or if you don't have a voice on that board, that's fine, but at least informational rights. Now, individual investors at the angel stage would rarely get informational rights in and of themselves, unless they're going on the cap table with a significant amount by themselves. But if you are part of an angel network, that angel network might be able to, through a side letter in the deal or otherwise, obtain informational rights and then funnel it to their members. That's what we do, especially if you have an LLC, that single purpose LLC that I talked about earlier. We get informational rights there. That just means you can look at the financials on a quarterly basis or whatever you work out and negotiate to help you ensure that you're keeping track, keep an eye on the health of the company. There's a lot of different levers you can pull apart from valuation to make sure that you are going in, again, eyes wide open. There's others, I'm sure, so feel free to fill in.
Sure. Yeah. No, I just want to plus one the informational lever, or the informational license, because we're now in a day and age where you can actually get live data from your startup, right? You can say, I want a license to be able to tap into your live dashboard and see how you're performing at any given time. It doesn't necessarily have to just be a quarterly basis anymore. A lot of things are changing. And so getting access to that early and getting a license for that will change everything for you. A major pain point is trying to follow up with startups and say, how are you doing? How are you performing? But getting that license is critical for being able to track them over time. So I would totally support that as one of the negotiating factors.
Seriously, I didn't expect that to be where you guys did.
What did you think it was we were going to say?
Just more generally about terms and the different types of notes, scenes and convertible notes. But that's because this is more where I play. But I prefer those answers to where I was going. So
yeah, they're all right. There are also terms that you can do and negotiate, and kind of what they call pro rata rights. There's a litany of them, right? So you could just Google that and find out. But those are also very much, part of the, especially when you are the one doing the term sheet. Now, if you're coming in, oftentimes like 757 Angels or CAV Angels, you're following in on somebody else's term sheet. So you don't really have an ability to negotiate the terms as well. Sometimes you can do a side letter. I'm kind of 50-50 on side letters, but if you are doing the term sheet, or if you have a chance to be a part of a group that's doing a term sheet, that is definitely where you can negotiate on some favorable terms, but they're terms that hopefully make sense and benefit everybody. So a lot of these terms are making sure that the investor gets another chance to invest more down the road, which as a founder, if you get along with the investor, you would want that, right? So just depends.
And I think it is often not expected that information rights are terms. This is part of a investor document. So it's not just valuations and discount rates. It is these communication rights and quite a few others. And I think too, if you're making the first investment in a company and you have a relationship with the founder, maybe you met them at a pitch event, you're talking to them about, I'm thinking about raising a round. That is an opportunity for you to get in there and start talking about the sorts of things you would want to see on a deal to make it happen. So it very much depends, but absolutely, if they already have a round open, they've already got investment, they're going to be a little less flexible. All right. And now, so this is a lot of text, but again, this is in case that this is shared afterwards. I just wanted to quickly show the number of early stage valuation tools. We've said a few times, it's more of an art than a science. This is a list of some of the common ones. And each VC group, each angel group, they might have different preferences on how they want to approach it. Some are purely market driven. Some can be much more rigorous in their calculations, but I wanted to go through a couple of them really quickly, specifically. So to the next slide. Oh, and so when I talk about market conditions, I wanted to share this just to show that valuations change over time. On average, they change over time. And when we're looking at this upward trend in the bottom right corner from PitchBook, that there has been an upward trend, but at the same time, the conversations that I'm hearing from a lot of founders is saying that there's a lot of downward pressure on valuation.
Oh, yeah.
But yet when we look at a seed round, all of a sudden the seed round is going up. So what's happening? I would love to get your thoughts on what's going on in the market. What do you see around valuations over time?
Sure. So, I mean, we saw like really high valuations a couple of years ago. And then, of course, we had like an economic downturn, and then valuations slowed and they declined. And when I talk to a lot of different VC clients, they're like, well, the valuations came down to where they're supposed to be. Everything was being overinflated, overvalued, and now they're leveling out where they're supposed to be. And then we're seeing that they're going back up. And so the pressure from the startups is, I think it can be the startups that are feeling like their valuation is maybe not as high as they would want it to be. But it's looking like even it is a little bit going down. You can see at the very end, like June 2023.
And I also, these are from different sources too. And so the way Crunchbase, I think this is Cooley-Go, the way Cooley-Go defines a seed might be different than how PitchBook defines a seed. So
sure.
And they have slightly different trends. So
Sure. So I think it is important to, again, to your point, like look at multiple data sources to understand where those valuations are headed. But at the same time, you want to look at the aggregate trend really across everything, trying to understand where is the market trending in general. But in terms of like startups and them feeling that pressure, I can see that. I can see why they would feel like valuations are going down. If you're seeing it sometimes going up in one and then down in another, I think it depends on the location, the geography, and also the investment stage. But
I would agree with all that, and I think your point about looking at it kind of on a more macro level is really salient. For a lot of people that got into the venture capital game, and I lump all of us kind of under this venture capital umbrella. I think a lot of us that got in over the last 15 years or so have only been through really arguably two, maybe 2.5 cycles. So if you go back further, to me, we're in another cycle. And so you're going to have cycles where you have high valuations, like we had, or what I would call founder-friendly markets, 5 years ago. And then now we're in kind of more of an investor-friendly market. That's going to start to turn at some point. I don't know when, but I think this is not out of the historical, ordinary, if you will. We're just in a particular cycle. And so I don't know the exact history of it, but it would be interesting to see an overlay of how this current cycle is relative to the last 25 years, or maybe even farther back. So I know I've spoken to some of my friends who've been in the business a lot longer than I have, and they're just like, this is part and parcel. So you have to, it's like an accordion, right? You have to kind of flex in terms of how you're viewing deals, how you're doing negotiations. But I do think right now it's shocking a lot of people only because some of us just haven't been through this type of cycle before. So there's some learnings, but this is also a time when, again, to your point, you look back on the macro and you can be informed and maybe be a little more prepared for kind of what to expect.
And we've noticed like a slight correlation with matching market trends overall. What are your thoughts on that? Like, have you seen that as well, or?
In terms of public and private markets?
Yeah.
I tend to see a 3 to 6 month lag between publics and private. So if you look at the public markets and the way they're headed, anywhere from a 3 to 6, I would say I start thinking, okay, well, 3 to 6 months from now, the private market might start to mirror that. But you probably would know better than I would.
Yeah, no, exactly. Yeah, and the correlation is like that difference over time, and then you see that it does have a correlation. It's not at the exact same time, but that correlation does seem to match the public and private market, which is a good indicator of what the private market might be doing.
And again, there are these considerations of where we are, what specific industry you're in. So at one point you might see in one industry things skyrocketing, like obviously right now, AI, metaverse, these big buzz terms, versus climate tech, health tech, deep tech, things that might be more capital heavy, different market conditions. We're going to see slightly different trends.
Yeah. Government subsidies, when they come into play, and then, the West Coast, East Coast is an interesting dynamic.
But that's tough. Raising a seed round on the East Coast versus raising a seed round on the West Coast, they could be two pretty different things. So all right, we can keep moving, and I won't have time to cover everything, but I'm gonna get there as much as I can. So this again is just a quick example of one method that VCs or angel groups might use to back calculate a valuation of an early stage startup. And this is making a ton of assumptions. So that's the big thing, especially when you're thinking about a pre-seed or a seed company. In order to get to these numbers, you have to have a guess of how much revenue they are going to have when they exit, so when they sell or are acquired, or IPO, of course, and what that revenue multiple will be on that sale. And you take your implied 10x multiple that you're going for, and then basically backwards calculate to a pre-money valuation. And from there, especially at the pre-seed, something that is really important is to remember the amount of dilution that is very likely to occur between now and the time that they get to an exit. So while this one looks like science, I want to point out that even in the scientific methods, there's a lot of push and pull. So if you were talking to a founder and they bring this to you, I think there's some questions you could easily probe at.
That I'm calling you.
So for example, how would you respond to a founder who says, I'm going to exit in 7 years at $50 million at a 7.5x multiple?
Well, I think that I'd say I'm glad that you did this exercise, number one. Number two, okay, let's continue to talk, because I there's a lot, as you said, there's a lot of, I think this is where the assumptions that brings into a broader kind of another kind of topic that I won't get into, but when you look at financial models and you're trying to diligence those, especially at this early stage, I care less about the numbers at the end, because they are crystal ball. I care about the assumptions on which those financial models are based, because you can stress test those. Presumably they're off of like realistic industry benchmarks or norms. So I think it comes into the assumptions of where this is key, and then how you want to assess the assumptions. So.
And then I'm going to quickly skip to the next one. This is a little bit softer version of a valuation of an early stage. Literally looking through a scorecard of things that you find important, looking at the founding team, assigning a weight, assigning an input, creating a factor, getting to a result that gives you basically, compared to the market, where it is with the industry, the location, multiplying this result by that valuation, you can say, okay, because this is an incredible team, because they're doing something super innovative, whatever it is, we think they're worth a bit more than the average startup in this similar space. So now I talked to Erika in advance of this about some of the quantitative and qualitative factors that go into valuations. And I wanted to hear if, in lieu of doing a really in-depth valuation, what are some factors that angel investors could use to come up with a sort of similar process for themselves?
Sure. So and just for like full transparency, I do the more in-depth one, where it is like you take this information and you put it into a machine learning model. You compare it against over 100,000 other startups, and then the model would tell you what the strengths and weaknesses are of the particular company you're considering investing in versus not. But again, if you don't have access to those tools, or you want to just try it on your own, this is very standard. I've seen this with a lot of different clients. The management, opportunity, product, sales, competition, and other, you can you can do easy calculations on your own with your own weightage, your own understanding of how well you think how strong they are in a particular area. Doing a little bit of due diligence as you're creating this by understanding what their product might be worth. And really like going on to their social media site, seeing how many followers they have. What does their opportunity look like, and what does it look like from their competitors, using their competitors as benchmarks? That's always a really good, easy way to understand. This is the de-risking model that we use for when we do due diligence on a startup. And just so everyone knows, there is a model, an actual machine learning model for each one of those bubbles, but you don't have to have a machine learning model for each one of them. You can do like the execution risk analysis. You can do the market risk analysis by doing a Google search, right? But the more advanced version would then be using a machine learning model that scans the web for their brand and seeing how many times their brand shows up in terms of how many times people are searching for their competitor's brand, and see how much of the market they particularly hold. Understanding the cultural and geographic risks of it, especially if they're a foreign entity. Like if you invested in a company in Israel right now, you might want to consider those things as you're doing your investment. And as I had mentioned when we first started, the risk is heavy in this early angel stage. And so making sure you just keep track of all of this is a really good framework to understand how to de-risk the startup, or how to understand the risk that you're going to be tapping into. Teams, they've talked a lot about teams throughout this entire conference, really trying to understand the experience of the team, the skills, and the diversity. One thing that I wanted to highlight that's really important, and in Silicon Valley it's very prevalent right now, is that VCs are looking for a diverse founding team. Why? Because now consumers want to see someone like them on the founding team. They don't want to see just, for example, it's a woman is buying a product. She wants to see that a woman is helping to build a product that she's going to buy. A lot of this is starting to trend and change. And so VCs are starting to shift and be like, we want to see more diverse founding teams because the consumers are actually asking for this. There's half of this world is females, right? And so you're going to have to appeal, or the company is going to have to appeal to 50% of a population, and having a female on that founding team is going to help with appealing their product to that particular audience. So being able to have that diversity in the founding team is actually really important to de-risk the startup as well. And then, of course, the tech risk. So there are actual machine learning models that will go through their tech, and it will point out and flag errors. Now, early stage, I just wanted to highlight, tech is always going to have bugs. It's always going to have errors. It's very, very early stage, but you could actually see if they know what they're doing. Like you could get into their model, you could run the analysis on it. It would highlight bits and pieces that could be errors, security issues with their tech, whatever, but you could get a general sense that they know what they're building. Or you could see this is not even really working. It's been haphazardly put together. It's not going to be a solid product moving forward. Maybe the team doesn't really know exactly how they're building this out. Anything that you wanted to highlight with early stage risk and being able to de-risk the startup or the investment as you're considering investing?
No, I mean, I think that what was just up there was, I think that was a great slide. I mean, that's one that when I do my diligence, I have a set of consideration questions that I've kind of accumulated through other best practices, and everybody kind of has their own way, but it's largely kind of tracks with each of those. And it's more manual. Obviously, it's not fed into a machine learning. That would be nice. But there are some basic questions I think that you're going to find across any type of diligence or risk analysis. And, it's around team, technology, traction, and then what I call the abilities. You have scalability, profitability, exitability. And I think, you can overcomplicate it, but you just got to find those common denominators that are at least going to get you kind of honed in on the essence of that company and some of the key risk factors, again, that slide showed.
And I think a lot of the times when I'm speaking to startups about this, they'll respond, well, the tech part, that's why I'm raising money, to figure that out. So I don't have an answer yet. And if you believe in them for enough of the other bubbles, I think that's a good enough answer at the seed stage.
Yep.
But maybe not. It depends on your thesis, your preference, what you really want to get behind. So now this is the last slide, and I promise I'll give up the stage. But I think just in summary, obviously, this has been said probably 100 times today. Startup investing is inherently risky. And this is something I think we all understand really well. But the sources of these risks are broad. I think Erika and Paul, they've talked a lot about some of these things you should look out for. Each of those things represent a potential risk to a startup business. One of my favorite risk analyses is the bus test, which if you haven't heard, it means if the founder is hit by the bus, will the business survive?
Yeah.
And a lot of early stage startups, probably not. But are they starting to develop the structure internally so that this could, in theory, continue to grow without them? Of course, there's multiple what we call valleys of death. These often happen after a seed round, after a Series A round. It's any time between funding and execution. And beyond investing, I think in the last moment, after the investment is made, I'd love to hear just a couple ideas for angel investors to de-risk investment after the check has already been signed. Is it okay if I
go for it?
Okay. So first of all, as we had said before, being able to track their data, getting licensed to track their data is very key and critical to be able to follow them. The second thing I wanted to highlight is that one of the number one indicators of success for early stage startups in our data set is not just their network, but their network's network. So not just who they're connected to, but who their secondary network is what helps them to be successful. So you are actually their secondary network. If you can give them resources and help them to be tapped into additional networks, that will help your investment to be successful. So I just wanted to highlight that as well.
That's tough all of those I would echo. Maybe the only other thing I'd add is, to the extent that you are able to do this, start to think about who the next tranche of capital providers are to help mitigate your investment risk beyond the operational risk and the execution risk. So it's never too early to start to kind of think about, okay, what's the next round look like? The founder's already thinking about that. The minute they close this round, they're already thinking about the next one. So even you as an angel can with your network, and I love that you brought up the networks. Come through LinkedIn, you probably have friends or friends of friends that are maybe at a VC fund that this might align with, and for you to make those introductions in an appropriate and timely way, that adds a lot of value. But I think you said it best.
Well, before we all get kicked off, can I get a round of applause again for our panelists? And feel free to come find them afterwards with additional questions.